Welcome back to Investing and Trading Live, sponsored by Online Trading Academy. As always, my name is Josh Lilquist, and we are having a good time here in the studio talking about some different income strategies in the last segment, how to use leverage in your trading and investing accounts, and how to be efficient with your capital. And we have investing classes where we walk you through that, we illustrate that. It's a physical place to go to learn about these techniques and strategies. To come into one of these classes, if you did miss it, just text the word investing to the number 210. 210 right now for 2 seats. You'll get a text right back with a link to our landing page. So you can pick your own date. Just text the word investing to the number 210, 210 right now for 2 seats for this class. Now, I want to talk a little bit about retirement strategies here. And because we see a lot of people that are coming to the academy, I would say the majority of the people that are coming in want to be able to retire at one point, and they want to have the opportunity to do that on their own terms. They don't want to have to work forever. They have retirement accounts, and they want to be able to do a little bit more with them, but have them last a little bit longer. And one of the concerns that I see have with people coming in is they're like, hey, I have these mutual funds, and they're not doing anything. They're not making me any money. They cost a lot? So I just did a little search here. I actually Googled, you know that you can Google things out. I Googled the real cost of a mutual fund. So let's just peek at that. So this is based from Forbes, and it says the real cost of owning a mutual fund. Now, there's people say and actually think that when they have an advisor or a broker managing their money, and their cost is going to be like what 0.75% or something for their management
Correct.
fee and all that, and they say, oh yeah, they're not charging me much for that. But I don't think they realize that you're actually paying for them to purchase certain mutual funds, which are devastating for a retirement account. And let's talk about why. So there's a few different costs that come along with a mutual fund, and this is from Forbes. You have an expense ratio. That's one. You have transaction costs. That's two. You have tax cost, three. Cash drag. I mean, there's some terms here. What the heck does that actually mean? If you want to, for those of you that are viewing the YouTube here live or recorded, I have the Forbes article up. So you have cash drag. That's four. Then you have soft dollar cost. That's five. That's another cost. Advisory fee. That's six. So basically, this is very conservative. In a non-taxable account, average is going to be minimum probably 3.17% according to this article. In a taxable account, 4.17%. That's just for the mutual fund. Now, you need that fund to perform at least 4% or 3% before you even break even. Now, we're seeing markets that are going down, so people are losing to the market. The market's down since 2021, about 10%, depending on when you're listening to the show. It is up this year 13%, but it's still down overall for the past few years here. But what people don't realize is they're actually down worse if you're in mutual funds, which are devastating to your retirement account. So Al, I want you to kind of discuss that a little bit and shed some light on that, but also what are some alternatives that people can do rather than just getting into these dogs?
Yeah, a couple things. You mentioned that your fund has to perform enough to offset the costs that are involved. Also has to perform enough to offset the impact of inflation. So you've got kind of a double whammy there.
So what is inflation at right now?
Well, inflation say around 4%. It was around 9% before.
So if inflation is at 4%, just as an average, right? And the cost of this is at 4%.
Yeah, that's the growth of inflation is around 4%. Yeah.
Yep. So and then this is at 4%, and you're losing a lot just by letting it sit in there in a terrible mutual fund.
Yeah, you mentioned I think 6 fees that you
I think there
found
was 6.
Well, according to our government, there can be as many as 17 fees within a 401k.
So this is a very conservative article.
It's very conservative. In fact, Jack Bogle, who started Vanguard Mutual Funds, he in the last few years of his life, he actually kind of came out and spoke down against most of the mutual funds out there. He felt that the returns were so mediocre and the fees so high that the public was being taken advantage of by them.
I think his comment was, or his quote was, "It's not what I intended it to be."
Yeah, that's correct. And he did an example where he used 2% as a fee and looked out over a 50-year time period. It cost about 70% of the return that you could have had you not had those fees. So one of the things that we talk about in these classes is how to eliminate or reduce fees. That's very important. But also you're put into something, if you're in a mutual fund, you're in a fund that, because of the size of it and because of all those fees, you're lucky if you get 4 to 6% on an annualized basis. So if you've got inflation growing at over 4% and you've got the fees that could be 2 to 4%, that pretty much is a break even to a loss. That's why so many people are in this financial crisis. And if you ask people what they have in their 401ks, their 403bs, most people don't know. They just put something together because it sounded good. And then Wall Street is basically telling you, just rely on the market. If you do this, if you just put money into the market, leave it there, you're going to be fine. Well, basically, you're hoping, you're guessing that it's going to be fine. You're hoping that it will be fine. But a lot depends on when you put that portfolio together. Where's the market when you do that? It depends on whether you go through a bear market or major corrections. And for anybody who's in their 50s or 60s or maybe even 70s, you're going to go through probably 3, 4 bear markets in your lifetime yet.
Yep.
Every time that happens, you could be looking at a 20 to 50 or 60% loss of your portfolio or drawdown of your portfolio. One of the reasons that people are looking at a portfolio that isn't where they thought it would be is because they let corrections take that money away.
Correct.
They're
Yeah.
not doing something to position themselves where they can either benefit in a down market or at least protect what you have.
What's interesting, as you're talking there, I pulled up another article from NerdWallet, very similar, and there's a shareholder fee. And you know what the fee is? It's a sales load. They're a commission. These are commissions you pay when you buy or sell a mutual fund.
Yeah.
Think about that for a second. You're paying a commission to somebody just to purchase it.
Depending on the load, right?
Exactly.
Yeah.
So what can people do differently?
Okay, well, there are a number of things you can do. If you want to be in a mutual fund, you can do that. But if you have an account set up, say, as a self-directed IRA, whether it's a traditional IRA or a Roth IRA, you have the opportunity to include things other than mutual funds. You can do mutual funds, but you can do exchange-traded funds. You can do stock. You can do options. You can do the foreign exchange market. You can do the futures market.
And that's truly diversifying yourself, too.
That is true diversification. Wall Street will tell you that you're diversified if you have equities or mutual funds that are spread out throughout the different components of the economy. Problem is you're in the same asset category, which is stocks, and the correlation becomes huge when the market is crashing or correcting.
So
You need
what-
to have things that are not correlated
Yep.
or inversely correlated or correlated so you can have the proper diversification, the proper asset allocation.
Yeah, real quick, what do you think is the biggest takeaway in the investing class that I'll give away seats to in a minute here? The biggest takeaway about retirement accounts in that class?
One of the biggest takeaways, and there's a number of them, but one of them is that you can have control over those assets. You can make a difference, and you can eliminate the fees. You can have assets that will benefit you in an up market and a down market, but you have control over that money. You actually are managing the money that's in your 401k, even though you don't know it, and you're paying somebody to let you basically manage your own assets. And so why not do that in a format where you can have additional assets to trade, like the Forex futures and options market, where you can benefit whether the market's going up or down. And the primary advantage is protection. You can protect what you have worked so hard for.
Yeah, imagine this. Just kind of sit here and imagine. If you're driving right now, don't close your eyes, but just imagine you were able to have the opportunity to increase your rate of return just by doing it yourself. Just by doing it yourself, eliminating a lot of those fees and not being in mutual funds. So imagine if you had a annual rate of return over the past 5-10 years or so, let's just say of 7%. Let's just imagine that, okay? Imagine if you did it yourself and eliminated a lot of that cost. Let's just say 4%. That's what, doing the math, 11%. That's a big difference over a course of 1 year, 2 years, 3 years, 4 years, 5 years. So if you're in your 50s and 60s, you have time to change this, and get on a right trajectory. So, but it's not going to happen if you just continue to do nothing about it. And that's why we've been having so many people that have retirement accounts coming into these investing classes that want to have more opportunities with their future. Really, they want to be able to do the fun things in life, and that's what it's all about when you get to retire, is being able to do the things that you choose to do, and that's having more choices. That's one of those 3 C's. Text right now to learn more about that, to get more information about how that actually works and functions, and what you actually have the ability and option to do with those retirement accounts. Text investing to the number 210 right now for 2 seats. When you do that, I'm going to give away a different type of pack today. It's going to be the jumbo pack, and there's going to be
fantastic.
some retirement strategies in there. So text the word investing, you're going to get a jumbo pack just for attending. So coming up next, we're going to talk about the barriers that are keeping people away from their financial goals, just like we did a few weeks back. Coming up next.